Welcome to the Leaders Insights podcast. Today's episode, the cash that was always there, the origin story of working capital as a funding source. Every CFO today talks about supply chain finance and dynamic discounting like they invented cash. But you told me before we started recording that the whole idea is embarrassingly old. Explain.
It's old, and it's a little humiliating, because for most of the 20th century, companies were sitting on enormous piles of their own money and couldn't see it. Working capital, the cash tied up in inventory, in what customers owe you, minus what you owe suppliers, was treated as furniture. It was just there. Nobody thought of it as a source of funding you could go draw down.
Furniture is generous. Sounds like they were actively ignoring it.
They were. The tell is in how firms financed growth. When a business needed money in 1965, it went to a bank or issued a bond. The idea that you could free up 40 million by simply collecting your invoices faster, that wasn't a strategy. It was an accident that occasionally happened.
So who figured it out first? Give me a name, not a concept.
Toyota, indirectly. The just-in-time production system in the 70s wasn't sold as finance. It was sold as quality. But the byproduct was that inventory, which is cash frozen in a warehouse, collapsed. Toyota was running inventory days a fraction of Detroit's. Ford and GM were financing months of parts sitting idle. Toyota financed almost none. That's a funding advantage. They just called it operations.
You're saying the first great treasury innovation came from people who weren't in treasury.
Every time. Finance is a late arriver to its own party. The operators solved it, and the CFOs wrote it up afterwards and pretended it was their idea.
Okay, but give me the number that makes a listener sit up.
The cash conversion cycle. The number of days between paying your suppliers and getting paid by your customers. Dell in the late 90s ran it negative, roughly minus 30 days. That means customers paid Dell before Dell paid its suppliers. Dell was funding its growth with other people's money, structurally, and it cost nothing. No bank, no interest, no covenant.
Negative sounds like a magic trick. What's the catch?
The catch is, you can only do it if you have power over the people around you. Dell squeezed suppliers on payment terms and got cash instantly from consumers with credit cards. A small parts maker can't pull that off. It gets squeezed from both ends. So working capital as funding is partly a physics problem and partly a bullying problem.
That's the uncomfortable part everyone skips. Dynamic discounting today, where you pay a supplier early in exchange for a discount, is dressed up as a favor. It's still leverage.
Of course it is. And the vendors selling those platforms, Talia, C2FO, publish figures showing tens of billions in early payments. Take those with Salt, they're selling software. They count gross volume. But the underlying truth holds. Your payment timing is a lever, and if you don't pull it deliberately, you're leaving free money frozen.
So what's the durable lesson, stripped of the buzzwords?
That the cheapest capital you'll ever raise is the capital you already own but can't see. Before you call a bank in 2026, with rates where they are, borrowing is not fun. You look inward. How many days of cash are sitting in your inventory, your receivables, your payment terms?
And most CFOs still can't answer that instantly.
Most can't. They can quote their debt cost to the basis point, but can't tell you their cash conversion cycle without a 2-week project. That's the scandal. The metric that reveals free internal funding is the one nobody has memorized.
So if a listener does one thing tomorrow morning,
calculate your cash conversion cycle for the last quarter. Days of inventory, plus days customers take to pay, minus days you take to pay suppliers. One number. If it's higher than it was a year ago, you've quietly borrowed from yourself at a bad rate, and you didn't notice. Fix that before you fix anything clever.
the cash that was always there. Thanks for the reminder that it's still there, unclaimed. That's it. The CFO decision tools are live at mba-training.com.